Hello everyone, this is Rob McDougall with Zhang Financial here with your weekly economic update. Today is Monday, May 18th, 2026. So the economic information that we had served up to us last week as we previewed really was all about inflation, and just as we previewed, it was not a pretty picture. A little worse than expected. We'll go through those numbers and then show you how the markets responded to it. So last week, starting on Tuesday, we had the CPI number, the headline inflation number, and the core CPI numbers. In terms of month over month, the headline number came in as expected, 0.6% up in April, which is a huge increase. And then core inflation, same thing. Consensus was right on. The actual number came in 0.4% up month over month. But the year-over-year number, certainly worse than expected. On the headline number, the expectation was a 3.4%, came in at 3.8. So at the consumer level, clearly price, we all know, we can see at the pump what is happening to gas prices. But in total, the whole basket went up more than expected in the month of April. So the next day, Wednesday, we get the PPI number, the headline number, the core number for the producer price index, and these numbers were way worse than expected. So the headline number for the month of April was expected to be up 0.4% month over month for April, came in at up 1.4%. And then the core number, excluding food and energy, was expected to come in 0.3%, up 0.3% month over month for April. It was a full 1% up. So those are really bad numbers. And PPI, those numbers, producer price index, those are numbers at the producer level. So they have to go through intermediate goods, finished goods, be distributed, hit grocery shelves. Those numbers will feed into the CPI for months to come. So that was not great information that we got last Wednesday on the producer price index. On Thursday, initial jobless claims, we've been on the theme, just mentioning the fact that the consensus numbers have had a hard time catching up with how good, how low the initial jobless claims have been. 2 weeks ago or last week when we reported, the actual number is a little worse than consensus estimates. Happened again this week. So estimates for last week were 205,000 new claims, came in at 211. Still, that 211 is a fantastic number. Coming into this year, we were averaging, if you just take a look at a 3-month average, around 225,000. So 211 is a really good number, but consensus expectations now has gotten a little aggressive. Also on Thursday, retail sales. Now, it's an important number, obviously. We've given you bad inflation numbers, but the consumer clearly is really hung in there. Retail sales, just a headline number for the month of April, up 0.5% month over month. The consensus was 0.6, so missed small. But then adjusted the ex-auto number, retail sales ex-auto, the expectation was a positive 0.6% month over month, stronger than expected at a positive 0.7. Now, inflation expectations, we show you this every week. It's a 10-year break even, 10-year treasury minus the 10-year tip yield. It continues to go up. So we had a nice stretch where we were in the 2.2%, 2.25%. But since the start of the Iran war, this has been edging up almost every week. End of last week, up at 2.49%. That's the highest level we've certainly seen this year. I think you have to go back to 2023 to see a number that's over 2.5%. We're right on the cusp of that. So that was up 4 basis points, again, reflecting some of that information, the CPI, and particularly the PPI releases that we saw last week. Now, GDP expectations, actually, that's been going up. I think this is the 3rd week in a row. Atlanta Federal Reserve has taken up their estimate for second quarter GDP growth in the U.S. Prior week was at 3.7%. They've moved that up to 4.0%. So just taking those few data points into account, what we expect for GDP growth, very strong. 4% would be fantastic. We grew 2% in the first quarter, so 4% accelerating. So if you got an accelerating GDP number And you've also got inflation that is moving up. Chances of interest rate cuts are certainly dwindling, and we do definitely see it in the Fed funds future market. So expectation for the June meeting, June 17th, no cut. Nothing is going to happen. They'll keep rates the same for sure. December, now this has changed dramatically in the last 3 weeks. 3 weeks, I think it was 3 weeks ago, we were looking at this, and the market was just starting to roll over from majority expecting one cut on average to the point where 3 weeks ago, I think we had 78, 80% of no change. Well, it's definitely changed. Now we're at 49% no hike, no change, but 39% odds of one rate hike, only or 12% odds of two or more rate hikes, and small 1% of one cut. So almost no chance of a cut. Small chance that we stay where we're at, which is 3.5% to 3.75%, and everything else is worse. So expectation for the Fed rate cuts evaporated, so the expectation is very solidly we're going to have rate hikes between now and the end of the year. So the markets, how did they respond to all that news last week, which was not particularly good? Equity was actually fine. It was relatively flat. If we look at the S&P 500, that was actually up 0.2% last week. So now on a year-to-date basis, the S&P 500 through last week, Friday, up 8.7%. Great start. Now, the Russell 2000 had been leading the way. That got hit the hardest last week, down 2.3%, still up, call it 13% year-to-date, so still better than the S&P 500. But they gave up a lot of ground last week, and it certainly makes sense. So in a potentially rising rate environment, really hurts small caps. 40% of their fixed income is, I think it's more than that, but I recently read 40% of their debt that they have is floating rate, not fixed. So if short-term rates go up, they feel it immediately. And they're also, as small cap companies, from a power structure standpoint, much less likely to be able to pass on price increases. So likely margin hit for small cap companies. So take away from that, last week S&P 500 a little better than break even, but small cap hit down 2.3%. International markets far worse certainly than the S&P. Again, the S&P up 20 basis points. Developed market ex-US down 1.5%. Emerging markets down about 2.5%. On a year-to-date basis, again, we'll go back, S&P 500 up 8.7%, which is now better than developed markets ex-US, up 6%, but trailing emerging markets, which are still up 19.5% year-to-date. Now, some pain last week in the equity markets, particularly international, but the most pain on a relative basis, definitely U.S. fixed income. 2-year yields last week just took off, up 18 basis points. 10-year yield up 24 basis points. So the Bloomberg U.S. Aggregate Bond Index down 1.14%, and much worse. So we don't have any of these long-term bonds in our portfolio, but long-duration bonds, we just use a Bloomberg U.S. Aggregate government loan, long-term government loan portfolio. That index was down 2.6% last week with that huge rise in the 10-year yield. So, economic data points this week. Now, we have 3 or 4 data points, I think it's 4 data points, that are housing related, not going to move the market. Pending home sales, month over month, year over year. The month over month is expected to be slightly better. Building permits, slightly better. Housing starts, slightly worse. So, we got housing out of the way. Initial jobless claims, this is the only one with maybe some potential to move the market. Expectation, again, last week was 211,000 new claims. The expectation for this week, 210,000. And lastly, and I promise you this will be the last time this is on a slide, hopefully, Michigan consumer sentiment, final number for May, 48.2. Prior month of April was 49.8. This index has been nothing but down, despite the fact consumer spending continues to be strong. So at some point, this indicator may have relevance in terms of predictive value, but the last couple of years, definitely not. So that's it for our economic update. You can hear the fire trucks are here to let us know it's over. So we'll sign off here. We thank you very much for your attendance, and we'll look forward to seeing you next week. Thank you.